Hey everyone, welcome back to Corporate Decoder, the place where we translate boring financial documents into juicy insights. And this quarter, the EQT Private Equity Company, LLC, is giving us quite the story to unpack. Get ready, folks, because this company is not just playing the investment game, they are redefining it, offering a whole spectrum of shares from Class D to Class T and H, each with its own little twist. But here is the kicker: as of the 14th of November 2025, some of these shares were not even on the books yet, talk about being ahead of the curve. Let us dive straight into the numbers. The heart of any financial report: as of the 30th of September 2025, EQT Private Equity Company LLC had assets totaling a whopping $380 million. Much of that is tied up in investments at fair value, meaning they are valuing their holdings based on what they think they can get for them in the market right now, and get this, their investments alone are worth over $356 million. That is a serious chunk of change. Now look at that growth from just over $7 million at the end of 2024 to nearly $381 million by September 2025. That is an astronomical leap, proving they have been busy acquiring things and making their presence known in the market. On the liability side, the company's debts and obligations are around $17 million, which seems pretty manageable given their asset base. It suggests they are not over-leveraged, which is always a good sign for financial health. And now for the net assets: the company's actual worth after accounting for everything, that is over $363 million split across all those different share classes. We talked about Class A D, Class AI, and Class A J1. Shares are the heavy hitters here, holding the lion's share of the net assets, and this is after the company made some serious investments buying up portfolio companies. Moving on to how they are making and losing money, let us look at the operations for the 9 months leading up to the 30th of September 2025. They brought in over $1 million in interest income purely from their cash holdings. That is the stable, predictable money. Now for the more exciting part. The real story is in the investment gains and losses. For the first 9 months of 2025, they saw a massive increase of almost $29 million in unrealized appreciation. That means the value of their investments went up significantly on paper, and that is on top of whatever actual profits they made from selling investments or from currency fluctuations. So after all the income, expenses, and investment gains, the company saw a net increase in its assets of over $27 million for the first 9 months of 2025. That is a very healthy result, especially considering they only really started their main operations in July of 2025. This suggests a strong start and a lot of buying activity. Let us dig into how those net assets changed for the 3 months ending the 30th of September 2025. The company saw a massive inflow of over $342 million from issuing new shares. That is how they funded all those acquisitions we are seeing take place. And that brings us to the end of September with total net assets hitting over $363 million, a huge jump from the mere $2,000 they had at the end of June. This is a company that went from virtually nothing to a significant player in just a few months thanks to massive capital injections. Now for the juicy part: what are they actually investing in? The schedule of investments paints a clear picture. Their portfolio is heavily concentrated in portfolio companies, which make up almost 98% of their investments. That is a massive bet on private companies. We see big names like Nord Anglia, Avetta, WSO2, IFS, and NeoGov on this list. These are not small startups, they are established businesses in sectors like services, technology, healthcare, and tech services. This indicates a strategy of acquiring and controlling significant players in their respective fields. This is not about a few small bets, it is about building a solid foundation of controlled assets. The remaining bit is in money market funds, a very small percentage. This tells us they are not playing it safe with cash, they are deploying it aggressively into their core investment strategy. Notice that most of these investments are valued at level 3. That means their value is based on inputs that are not readily available on the open market. This often involves a lot of management judgment and estimation, which can be a double-edged sword. It offers flexibility, but also introduces risk if those estimates are off. When they value these level 3 assets, they are heavily leaning on market comparables, about 67%, and transaction prices, about 33%. This means they are looking at similar companies and recent deals to figure out what their own investments are worth. For example, they are using enterprise value to EBITDA multiples ranging from 13.6 to 18.6 times. That gives us a sense of their valuation approach. It is a common method, but the exact numbers are still based on those harder to pin down unobservable inputs. Now let us look at how they do things behind the scenes. This company is quite new, formed in June 2024, but it is structured to avoid being called an investment company under the law, which is a clever move. They are sponsored by EQT Group, a big player in private equity, and they have operations that officially started in July 2025. So all this financial activity we are seeing happened in a very short period of intense growth. They are following United States generally accepted accounting principles, which is standard, but they are using specialized guidance for investment companies. This means they value their investments at fair value rather than historical cost. That is important because it reflects current market conditions, not what they paid for it. They are not consolidating most of their investments unless it is a wholly owned subsidiary that provides services to them. This is typical for private equity firms that take stakes in other companies rather than owning them outright and running them directly. This is a big one. They rely heavily on fair value measurement, meaning they are constantly reassessing what their investments are worth based on market conditions. And their own estimates, this is where Level I 2 and 3 come in. Level I is easy observable prices. Level 2 is observable inputs for similar assets, and Level I 3 is the tricky one with unobserved. Variable inputs like management's own judgment. They admit that when they use level 3 inputs, the judgment exercised by the manager is the greatest. This is where the story gets interesting. They are making educated guesses on valuations due to lack of clear market data. And here is where the executives get their payday. The performance allocation is a big deal. It is 15% of the total return after meeting certain hurdles. And a high watermark, that means if the company does well and makes a profit based on its net asset value, the management team gets a significant cut. This is a common incentive structure to align management's interests with investors. But it can also mean big payouts for the team if the company performs spectacularly. The company pays a management fee based on its net asset value that is a recurring cost of doing business. They pay their manager a percentage of the assets under management, typically 1.25%, but this can vary based on share class and initial periods. This fee is the steady paycheck for the management team regardless of how the investments actually perform. They have been actively acquiring companies, issuing new shares to make these deals happen. Notable acquisitions we see here are in companies like Jeb's Img Academy of Veda and CluePoints, all in 2025. These are strategically important acquisitions that fit within their broader investment themes, likely in technology, healthcare, and education. Beyond share issuances, they also made cash acquisitions like purchasing interests in Niwa's Housing Finance and Zeus for significant amounts. This shows they are using both equity and cash to build their portfolio. This table confirms it. Almost all of their $371 million in investments are in level 3. Assets, meaning their valuations are heavily based on internal estimates rather than readily available market prices. Only about $15 million is in stable money market funds. The bulk of their level 3 assets are in portfolio companies worth over $356 million. That indicates a high concentration in private equity assets where reliable market pricing is not always available. This section spells out their valuation methods for these private companies. They use market comparables and transaction prices, but the unobservable inputs are key here. The weight ascribed to each method and specific multiples like enterprise value to EBITDA are crucial for determining fair value. It is a sophisticated approach but relies heavily on those estimates. Looking ahead, their main plan for their cash is simple: acquire more portfolio companies. That is where the money is going. This might also involve debt financing in the future, but for now, it is all about deploying capital for acquisitions. For the 9 months ending September 2025, they used over $241 million in operating activities, which is mainly buying these portfolio companies. This is a company in aggressive growth mode, spending heavily to build its asset base. And where did they get the money to do that? Over $256 million came in from issuing shares. This is the lifeblood of their operation funding, their aggressive acquisition strategy through continuous offerings of their stock. The thing to watch here is the difference between their transactional net asset value and their GAAP net asset value. The transactional NAV is what they use to price their shares when buying and selling them, and it is influenced by things like accrued shareholder servicing fees. The GAAP NAV is what is reported by accounting rules as of the 30th of September 2025. Their transactional net asset value per S-Hair varied across the different classes of shares, reflecting their specific fee structures and performance metrics. The company is open about its valuation process. They use market comparables and transaction prices for private companies, but acknowledge the significant reliance on unobservable inputs like multiples for things like enterprise value to EBITDA and revenue. This is standard practice in private equity, but it does mean valuations are estimates, not hard facts overall. This report paints a picture of a very young, but Incredibly active private equity firm EQT, private equity company LLC, is aggressively deploying capital, acquiring significant portfolio companies, and growing its asset base at a phenomenal rate. The massive increase in investments and net assets from almost zero to hundreds of millions in less than a year is remarkable and shows a clear strategy. Yai. To grow through acquisition, the biggest strength here is undoubtedly their access to capital, allowing them to make substantial investments, and their strong ties to EQT AB Group, giving them a robust platform and expertise. The company is clearly focused on growth and leveraging that into significant returns. That performance allocation structure also means management is highly incentivized to drive those returns. However, the key risk lies in the valuation of their level 3 assets, because these are private companies with no readily available market prices. Their valuations are heavily reliant on management's estimates and models. While they describe a rigorous process, there always remains a risk that these valuations may not reflect the ultimate realizable value. This is a common challenge in private equity, but it is worth keeping an eye on. The company's direction is clearly towards building a controlled portfolio of significant businesses. The rapid pace of acquisitions and capital raising indicates a strong belief in their strategy and a focus on strategic as opposed to passive investments. In conclusion, EQT Private Equity Company LLC is a company in hyper growth mode, leveraging significant capital injections to acquire a diversified portfolio of private companies. While their aggressive strategy and reliance on estimates introduce inherent risks, the potential for high returns is also evident. This is a company to watch closely to see how these acquisitions perform over time. Alright, that is our dive into EQT Private Equity Company LLC's latest filing. What are your thoughts on their aggressive growth strategy and valuation approach? Let us know in the comments below if you found this breakdown helpful. Please hit that like button. It really makes a difference, and subscribe for more corporate deep dives, and do not forget to join our growing community on Discord. The link is in the description below. Thanks for watching. See you next time.